You went to the grocery store, maybe last week, maybe yesterday. You grabbed the basics, eggs, bread, whatever you needed, and something felt off. Not dramatically wrong, just quietly wrong. Like the prices no longer matched what you remembered. Then you opened your phone and you saw this: the stock market. Best month in 5 years. That's not a dumb question. That's one of the most important questions you can ask right now. And the answer is going to change how you look at financial news permanently. Let's get into it. So let me ask you something. If inflation is still rising, if your groceries cost more, if the Fed isn't cutting rates, why is the stock market going up? Here are the facts, straight from the U.S. Bureau of Labor Statistics. Inflation in March 2026 came in at 3.3%. The biggest single-month jump since 2021. Prices are not falling. Prices are rising. Meanwhile, the S&P 500 surged roughly 13% since late March, its sharpest rally since April 2020. The Federal Reserve hasn't cut rates. No cuts are coming anytime soon. Borrowing is still expensive. The cost of living is still going up. And yet, Wall Street is having a party. So what's going on? Is the market broken? Are investors crazy? Or is there something the headline number is not telling you? The answer is this: the S&P 500 is not what you think it is. Here's what most people don't know. When you hear the S&P 500 is up, you probably picture 500 companies all doing well. American workers, busy factories, full restaurants, booming small businesses. That's not what's happening. Think of it like this. Imagine someone shows you a restaurant index for your city, an average price across 500 restaurants, but the index is weighted. The 5 most expensive places in the city count for 30% of the average. So if those 5 fancy restaurants raise their prices, the index goes up. Even if your local diner is struggling to keep its lights on. The S&P 500 works the same way. A small group of companies, like roughly 7 to 10 of the largest tech firms, are doing the heavy lifting. And those companies don't care about the price of eggs. They don't care about oil. They operate in a completely different economic reality than you and I do. According to Goldman Sachs research, AI-related investment is expected to drive roughly 40% of all S&P 500 earnings growth this year. 40%. From one theme, from companies building and selling the infrastructure for artificial intelligence. That is not the economy. That is a very specific bet on a very specific technology. So what's actually powering those earnings? Let's follow the money. The biggest cloud computing companies are in an arms race, not for weapons, for AI infrastructure, data centers, servers, GPU chips, the physical backbone of the AI economy. The 5 largest hyperscalers, Amazon, Google, Microsoft, Meta, Oracle, are expected to spend over $600 billion on capital expenditure in 2026. That's a 36% increase over last year. And roughly 75% of that spend is directly tied to AI infrastructure, not traditional cloud computing. And by the time the Magnificent Seven earnings came in this quarter, the estimate jumped again. $670 billion, more than 90% of what these companies expect to earn this year alone. Now here's why this matters for the stock market. When Amazon spends $150 billion on data centers, that money flows somewhere. To chip makers, to construction firms, to cooling systems, to fiber optic cables. All of those companies see revenue. Many of them are in the S&P 500. So the index rises, not because your grocery bill got cheaper, but because a handful of tech giants are making an almost incomprehensibly large bet on AI. And the stock market, which is essentially a machine for pricing future expectations, is saying, we believe that bet is going to pay off. Here's the other crucial piece. Normally, when inflation rises, it hurts corporate profits. Raw materials cost more, workers demand higher wages, borrowing gets more expensive, margins get squeezed. But those dynamics hit manufacturers, they hit retailers, restaurants, logistics companies, industries where physical stuff is made and moved. Goldman Sachs research points directly to something they call the limited oil price sensitivity of the S&P 500. In plain English, and the biggest companies in the index barely feel rising energy costs. A company like Google or Microsoft doesn't have a massive oil bill. Their raw material is data, code, and engineering talent. Their profit margins are among the highest in history. Rising inflation barely touches them. Meanwhile, rising AI demand directly boosts their revenue. That's the engine. It's clean, it's powerful, and it has almost nothing to do with whether you can afford your monthly groceries. So let's name what's actually happening. Because this is the most important thing I'm going to say in this entire video. There are two economies running in parallel right now. There's the economy you live in, where inflation is real, where your rent went up, where groceries cost more, where interest rates are high and a new car loan feels brutal, where the gap between your income and your expenses feels like it keeps widening. And then there's the economy the S&P 500 mostly reflects, where a handful of companies are generating enormous earnings by selling AI infrastructure to each other and to the world, where the future looks like it's worth betting on. These two economies barely overlap. Goldman Sachs research notes that market breadth, the share of stocks actually participating in the rally, has dropped to one of its narrowest levels since the dot-com era. Most companies in the index are not doing great. The rally is being carried by a very small number of stocks. The headline number is misleading you about the health of the broader market. So when you feel like the stock market is lying to you, you're not wrong. You're just seeing two different realities at once. Now, none of this means the market is doomed or that you should panic. But it does mean there's a real risk sitting underneath this rally, and the headlines aren't emphasizing it enough. Goldman Sachs research puts it this way: the history of technology breakthroughs tells a consistent story. From the steam engine to railways to PCs to the internet, every major technology revolution attracted enormous capital to build the infrastructure. And in many cases, the companies that built it didn't profit most from it. The benefits flowed to the companies that used the infrastructure, not the ones that funded it. In other words, the companies spending $600 billion on AI infrastructure might not be the ones who capture most of the value. That's happened before in every major technology revolution. And there's one more layer of risk worth understanding. These hyperscalers are now spending more on AI than they generate in free cash flow. They're bridging the gap with debt, transforming what were historically all cash business models into leveraged ones. That works, as long as the AI revenue materializes fast enough. But what if it doesn't? The math gets uncomfortable very quickly. So let's bring this home. The market is up because a small number of AI-driven companies are generating enormous earnings expectations, and the stock market is pricing in that future. It's not lying to you. It just wasn't built to measure your life. Your grocery bill and the S&P 500, they were never tracking the same thing. The market is not telling you life is getting cheaper. It's telling you that a handful of companies are making a $1 trillion bet on artificial intelligence. Whether that bet pays off, that's the question that defines the next decade. If this gave you a new way to see the market, we're just getting started. Subscribe so you don't miss what's next. And one question before you go: does the stock market feel disconnected from your real life right now? Drop it in the comments. I'm genuinely curious.